Okay, it is 11 o'clock. We can get going, I think. So I've got a tiny bit of news to do this week, and then Richard's actually got some more interesting things. And then I'm going to be talking to Ken from Strategic Equity Capital. So my bits of news first. Premier Miton and Hydrogenone, both tiny. This is properly tiny now, the Premier Miton Global Renewables Trust. So the market cap of the ordinary shares is at just 19 million. So the fund's bigger than that because of the split cap, as we explained second. And it's split between ordinary shares and zeros. And those zeros need to be repaid on the 20th of November. And those were issued 5 years ago, providing finance at about 5% per annum. And when they were issued, the assets were enough to cover the repayment of those 2.4 times. Things haven't quite worked out that way now. If they were going to try and replace those, if they were going to try and soldier on, they'd have to pay an awful lot more for them. I mean, the EJF zero that just issued came at 8.5%, and that's despite the fact that it was covered 3 times. So the board has understandably concluded it's got to wind up the trust. So shareholders are going to be offered the choice of cash at NAV or a rollover into an open-ended fund with a similar-ish mandate, but it's not the same. So the Premier Miton Trust has been through a series of incarnations of different sort of things. This is sort of hiking back to sort of what it was a few years ago, which is sort of more infrastructure and utilities mandate and a much lower yield, so 4.1%. Now, I've put these stats up here, and this is probably the meat of what I'm trying to say, really. You can see that the trust has been pretty poor. I'm looking especially at the 5-year numbers there. The open-ended fund that they're proposing as a rollover vehicle has done a lot better and has outperformed its peer group. So that's the investment association sector. But if you look at the Ecofin trust, which is the one that Premier Miton Global Renewables sits alongside, it's in the same peer group, it's done way better than all of them. And it's the only one that's beaten all of these indices. In NAV terms, at least. It hasn't done in share price terms, and I think that's kind of the point of why I think it makes a good rollover potential. So there'll be a circular published soon. Obviously, there'll be votes around this. I'm assuming people are going to vote to approve this, so the whole thing would happen in December. Anything might happen between now and then, but I would recommend at the current stage that you basically take the cash and roll into Ecofin, because you'd be picking Ecofin up on an 8 discount. It's got much better performance. The yield's about the same. It's a little bit less than the open-ended fund, but it has got a track record of growth. And I just think that's probably the better option. But there we go. Hydrogenone capital growth. The assets nominally are a lot bigger than the one we've just been talking about, but the market cap's only 33 million, and that is because of the very big discount. And it's obviously been struggling for a long time. So what happened yesterday is the shares got suspended, and the reason is the new manager and the board are not yet ready to say what the end of June NAV is, and they don't think they'll be in a position to do that until at least late October. And so they can't publish their interim accounts, and so they have to suspend the shares because of the FCA rules. What they're saying is there's a material uncertainty about the trading position of 4 investee companies. So these are all early stage things. All of them, were acquired on the basis that they would sort of not all of them profitable at the beginning, not all of them had sales at the beginning. So some still need funding. This is still an early stage investment, and we're in various stages of negotiations for funding for those. HGen was always going to be disadvantaged because it hasn't got the cash to participate in this, so there's a pretty strong risk of being diluted. But the interesting thing is that the board is saying there's a material change, for the worse since the end of March. And they also said that there were delays in the provision of information from the previous managers, and that's one reason why this is all taking too long. They've got about £1 million in cash sitting on the balance sheet, which is enough to keep going for a little while. They're looking at selling one of the investments, so they're also looking at debt funding. Now, I think debt funding is a bit of a strange idea. Maybe they're just thinking that if we do need working capital and we can't sell anything, then maybe we'll dip into debt until we've sold something. That would sort of make sense, but I'm not particularly a fan of it gearing up at all. Right, that's enough for me. I'm going to hand over to Richard. So 1 second.
Thank you,
Richard, all
James.
yours.
Cheers. Right, yeah, so a couple from me, conclusions of strategic reviews. So firstly, PRS REIT. So here's its chart, and it's sort of familiar territory for investment REITs and real estate companies, really. So discount widened, and then you see the spike in the middle of last year, and that's due to shareholders requisitioning the board, and that resulted in the chairman being replaced by Robert Naylor and Chris Mills, who are the guys behind who are behind Achilles, and they've gone in and turned around a couple of trusts recently. That prompted a strategic review. It put itself up for sale in October, and then action really started happening sort of this summer. So in June, it received an offer from Long Harbour at 115p per share, which I thought was too low. And it turned out that that company hadn't even secured funding for it to conclude the deal or anything. So that seemed like a non-starter anyway. And then last week, share price jumped because there was press speculation about KKR coming in with a bid. They confirmed that they were in discussions on that, so everything looked good there. And then earlier this week, it announced that it accepted a bid from Waypoint Asset Management, who are on behalf of some UK local authority pension funds, putting a bid for the company. That was at after costs around what Long Harbour had offered way back in June. So 115.3p a share, which, as I said at the time, I think is too low for this. So it's the sale of the holding company. So if it goes through, they'll liquidate the REIT and distribute the net assets to shareholders. They propose this being completed by the end of November, and the dividend that's due in November will still be paid to shareholders. And it's saying it's accepted this because it's not received any proposals that are better than this. So I can imagine the negotiations with KKR haven't really come to anything, or they don't see it coming to anything. And they say it provides greater certainty and that cash will be returned to shareholders. As a part of the deal, they've agreed not to solicit interest from third parties, but they can still engage with third parties if they do make an offer. So it's still not out of the realms of possibilities that a counterbid could come in. And they've also interestingly put in a break clause. So if they do go with a counter offer, they'll have to pay Waypoint 5.7 million, which is interesting. So will there be counter offers? I don't know. With that break fee, it would have to be above 118.7p. So it could happen. The share price is still way below what the bid price is. So I think shareholders are skeptical whether a fresh bid will come in. And like I said earlier, this is way below the NAV. I know this NAV hasn't been updated since December, but it's still a hefty premium. And I've said it before, I like PRS REIT. I liked what they were doing. They basically build houses for rent, and it's a sector that's got massive supply and demand characteristics, good, which we all know about in the residential sector. So it was just a shame that the board decided to offer the manager a long-term contract, like 3 years, which obviously put the backs up of shareholders and led to this. So I hope there is a counter offer that comes in and some kind of bidding war and shareholders get more, because I think this still undervalues the company. Next is Life Science REIT. So we talked about this before. It's launched in sort of end of 21, and it's just been a terrible performance since then, really. So it's on a discount of almost 50%. And basically, the concept of the company was to buy and develop, or buy office buildings and redevelop them into lab spaces, and they can get a massive markup on rent between office space and what they could charge life science companies, and then obviously the uplift in value from that. So it all came from a good place, but the market's just, the life science market's just crashed. The funding isn't there, and therefore the demand isn't there for tenants. So they've really struggled to put into practice their strategy, and so they've discount has widened and widened and widened. Obviously, we've had the interest rate rises and things like that, which have been a big burden for them as well. So they launched a strategic review earlier this year. They came out today saying that the outcome of that, they're going to pursue a managed wind down rather than the sale of the company. They have been talking. They've had offers or potential offers, proposals put to them, but they have come to a conclusion that selling the portfolio sort of piecemeal over the next 12 to 18 months would garner greater value than if they were to take one of these offers that have been proposed to them. So they've obviously got confidence that they can do this, and they've had proposals for a couple of their assets during this strategic review. So that obviously gives them confidence that there is a market out there and investors out there for this, for their stock. And they also say that within the next 12 to 18 months, which is the period they reckon they can get this all concluded by, they'll be able to enhance the values of some of these assets with new lettings and other sort of asset management initiatives. To do this, they'll have to amend the investment policy, and they're looking at sort of the management fees as well to incentivize the sales, and that will need shareholder approval. So the reaction today, the share price went down in early trading sort of 1%. So you can see that that shareholders probably don't approve of this too greatly. They probably want their money back quicker. And interestingly, Saba is on the register over the last few weeks, and yesterday, it was announced today, but yesterday they upped their stake to almost 6%. So it'd be interesting to see what they will make of this and what will happen there. Just quickly on the portfolio, so they've only got 5 assets in what they call the Golden Triangle, which is of the life science sort of industry. So that's between Cambridge, Oxford, and London. It's valued again at December valuations was 385 million with taking off debt. So the net assets is 262, and like I said, their market cap's way below that. So they'll be looking to get as close to the book value as possible. So there's 2 in London, and this just shows how they haven't been effective in their strategy, really. So with the converting the lab space, so with Herbrand Street, for example, they recently did a deal with the original office tenant there to let that up again to them, so renewed that lease. So they've obviously given up there, and the big one that they've got is Oxford Technology Park, which is still being developed, sort of new blocks and new buildings there. So that's probably why they want to do this, to get a couple more of them out the way and let, and the value of that will obviously then go up when that's done. So like I said, we'll wait and see. It needs shareholder approval. We'll see if that goes through, or whether they will push for a sale of one of the offers that's on the table. So watch this space, really.
Brilliant. Thank you, Richard. We will now bring in our guest. So there's a legal bit for us, and then Ken. So I'm going to hand over control of the slides to you, Ken, and let you tell us all about Strategic Equity Capital, please.
Yeah, thank you very much. Good to be here. I'm Ken Wotton. I'm Managing Director for Public Equities at Gresham House Asset Management, and Gresham House is the manager for Strategic Equity Capital PLC, which is our listed small cap investment trust. So I will give you a quick canter through the Strategic Equity Capital, which we refer to as SEC. I'll give you a quick canter through the story and the strategy and some case studies of some of the companies we've invested in. It's worth just acknowledging up front that earlier this week the company released a circular and announced a set of proposals relating to a tender offer and potential realisation of capital for shareholders. There's a detailed circular document and an announcement, and that can be found on the company's website, strategicequitycapital.com. So I would refer shareholders and potential shareholders to that document for the details, but I'm sure there may be some questions on that process at the end. So I'll just stick to the story in terms of the actual opportunity for the trust for continuing shareholders, which we think is pretty compelling. Some disclaimers, which I'm sure you can read in your own time. So, Strategic Equity Capital PLC. What is it? It is a London-listed investment trust. It's about 160 million market cap, just shy of 180 million net asset value currently, and it's focusing on the UK smaller companies space. It sits in the UK smaller companies sector within the AIC sectors. It's a highly concentrated portfolio, typically between 15 to 25 holdings, and at the moment it's about 18. Well, it's not about, it is 18. And it's a pretty distinctive approach to investing in this part of the market. Highly concentrated. Most of the value of the trust is in the top 10 holdings. And those top 10 holdings, we are taking a private equity approach to investing in public companies, typically taking larger equity stakes in those businesses, and then trying to actively engage with the management teams, the boards, and other stakeholders in those companies to support value creation or to help catalysts that will realise value in those businesses in a way that is not reliant on the UK smaller company sector or the UK equity markets performing strongly to be able to deliver value, and that's pretty important given current market uncertainty. We position the strategy as sort of somewhere between a typical public equity strategy and a typical private equity strategy. So hence we are quite different to most public equity investment trusts or open-ended funds that you might be able to invest in. A typical public equity fund would be fairly diversified, so they'd be trying to manage and mitigate risks through diversification, typically have more than 50 holdings, in some cases well over 100 holdings. That means that each individual holding is relatively small in the context of the whole fund, and the influence and control that the fund manager has over those investments is limited by the fact that they typically would be quite a small shareholder. Also, those funds are typically measured and the managers are incentivized relative to an index benchmark. So it's a kind of relative performance game. And that's quite different to private equity, on the other hand, where it's much more concentrated, 10 to 15 holdings typically, where often there's a controlling stake in a company, so you have a lot of influence, and where the ownership style is very active, so typically have board seats, and where you would really expect those managers to be putting a lot of resource into each individual company. As a result of that, each company matters a lot to performance, but also it's worth pointing out that typically private equity use a significant amount of financial leverage in their structures, which enhance returns if things goes well, but also creates an additional layer of risk for the underlying investors. And SEC sits somewhere in between that. So we typically have around 20 holdings, as I said, currently 18, take significant stakes, but minority ones. Because they're listed companies, we typically don't have board seats, although sometimes we introduce people that we know that we think are good quality to the board of the companies. We don't have significant leverage. So from that perspective, these are lower risk investments. And we think that blend is a really attractive sort of combination of the liquidity and flexibility of public markets, but with some of the influence and direction and supervision that comes with private equity. Gresham House, as a fund manager, we think is very well placed to exercise this strategy. We have a well-resourced platform. We have a private equity business within Gresham House. So my team in the public equity side of the company interact very proactively with our private equity colleagues to try and leverage insight, experience, and situational knowledge from private companies that are often in the same sectors that we're investing in the public markets, to try and drive an extra edge in terms of our understanding and our ability to forecast the potential value upside of these businesses. We have an investment committee similar to a private equity style structure, which gives an extra layer of scrutiny and oversight, given that we're taking quite large positions relative to the size of the fund. And then we have a very well developed private equity network of people that we know and trust, and who colleagues work with extensively, who come from these various sort of groups of people that we have at the top here. So non-exec directors, current and former chairs of companies that we've invested in, both public and private, specialist advisory businesses, M&A boutiques, buying and selling companies in particular sectors. And all of these people we can draw on to try and help us make better decisions, to originate ideas, and also potentially to get involved in the companies after we've invested in a proactive way. I've talked about being actively engaged. This is a critical component of our strategy, and it's quite different to most other public equity investors. There's a number of areas we think we can add value to, and it depends on the situation. We're not trying to tell company management teams how to run their business. They understand their sectors and their customers much better than we do. But what we do understand is what best practice looks like, and we are very clear about what matters to create value for shareholders. And you can see on the right-hand side, there's a number of different levers that we have, where we in different situations may get involved to try and enhance value. And that might be strategic advice. It might be providing capital for acquisitions. It may be trying to align management incentives with long-term shareholder value creation. It might be M&A. It might be helping to tell the equity story better to the market to attract new marginal shareholders. There's a whole host of areas we think we can potentially get involved, but each situation is very different. So just very quickly on performance, I took over as lead manager of this trust in September 2020, and since then we're pretty happy with the performance, both in terms of the NAV performance, but also in particular the shareholder total return from the share price perspective, because the discount has narrowed materially since we got involved, and it compares favourably over most time periods with our peer group and the sort of wider smaller companies universe. And our approach has been working, and across our wider platform, it's sort of very pleasing to see we've got a lot of external recognition of what we're doing, both awards, both for SEC and for our other small cap and mid cap focused equity funds. They're all UK centric funds, and various other sort of recognition. So I won't dwell on this too much. So SEC, what does the portfolio look like? I said before that it's a very concentrated portfolio of companies, and that the majority of the value of the portfolio sits within the top 10 holdings, and here are the top 10. I'm not going to go through each of these in detail, but what you can take away from this is that there's a reasonably diversified sort of set of companies in different sectors. Each one of these, we think there's a clear value opportunity and a clear opportunity for us as major shareholders to engage with those companies to try and support that value creation journey. And precisely what that looks like varies from company to company. But as I said, we've got a good playbook and a very well developed network that we can try to apply to these businesses to help them. I'll talk about a couple of them in more detail in a moment when I give some case studies. But it is these companies that will drive the value for SEC shareholders over the next few years, and we think there's a pretty compelling case in each of them. In aggregate, this is what you get if you buy SEC today. So the top 10 holdings, as I said, represent the majority of value. At the moment, it's just over 3/4 of the total NAV from those companies in the previous slide. If you look at the aggregate financial profile of those businesses, we think it's pretty attractive. So high single-digit revenue growth. So these are growing businesses, even though the economic environment is uncertain. These are growth companies. They're companies that are growing their profits faster than their revenue. So they're showing margin expansion, so 14% EBITDA profit growth. They have high margins, over 20% EBITDA margins, which we think is a good indicator of the quality of these businesses, and also gives them a degree of resilience in what is an uncertain market environment at the moment. And they don't have much leverage. In fact, in aggregate, the weighted average leverage, when we look at net debt to EBITDA as a measure of leverage, in aggregate, these portfolio companies have net cash on the balance sheet, so they don't have any debt in aggregate. Some of the businesses have moderate debt, and others have net cash. But in aggregate, this is not a leveraged portfolio, so in direct contrast to a typical private equity portfolio. So we think that profile of growth business, high margins, low or no leverage, really makes these businesses robust and resilient, and sort of enhances their ability to sort of bounce back from any setbacks, which obviously do happen in smaller companies, and to create value over the long term. And all of these characteristics, which we think represent sort of above average quality relative to the overall small cap universe, the valuation of those companies we think is pretty compelling. So we are able to buy these businesses at the moment. This is a NAV rather than the kind of sort of discount to net asset value, just over 9 times enterprise value to EBITDA. We think that number is pretty compelling, particularly when we compare it to mergers and acquisitions that we've seen of similar businesses in private markets, and also the sort of average value of takeover offers that we've seen across the UK small cap market over the last few years, and not least takeovers we've had of portfolio companies that meet our criteria in SEC. And I'll come back to that in a minute. So we take those financial characteristics, and this is just an illustration, so this is not a forecast, just to be clear, but this is taking those financial characteristics and those valuation numbers and then rolling them forward. And we can see a clear case from an illustrative perspective of how a NAV per share of SEC today, which is around £4 a share, could easily get to £10 a share over the next 3 to 5 years, or possibly even in an upside scenario over £12.50. So as I said, that's not a forecast, but that is taking the current financial characteristics, assuming a modest re-rating to 10 times EV/EBITDA to get to £10 per share, or applying the average takeout multiple that we've seen from portfolio companies in SEC over the last few years to get to the upside case. So I said I'd give you a couple of case studies. I will canter through these in the interest of time, but I'm going to cover 3 companies. One which has been a great success on the market, which we still own, but where we've been top slicing. One where there was a takeover offer, which is a good example of how we, through our proactive engagement, have recovered value from a difficult situation. And the last one is one of our kind of key upside assets that we have in the portfolio today. So XPS Pensions, it's an actuarial consultancy business focused on the defined benefit pension sector. That might sound boring, but actually it's a really exciting sector with some really strong double-digit growth rates, and that's really being driven by the increasing burden of regulation in the pension sector. And XPS is a provider of regulatory consulting and administrative services to the trustees of defined benefit pension schemes. So there's a lot of work for them at the moment. They've been growing really strongly. We've engaged with the company pretty proactively over the last few years. We were the largest shareholder a couple of years ago. And as part of that engagement, for example, we successfully sort of supported the introduction of two new independent non-executive directors to the company, one of whom has just taken over as the chair of the business very recently. We were very positive on this company because we could see that it was trading at a very big discount to the multiples where private equity had been buying similar businesses in private market. There's been a lot of transactions in this sector. And so we had a big margin of safety on valuation when we first invested in this company. As it happened, the company performed extremely strongly and it continues to do so. It's had a number of forecast upgrades over the last few years, and that's resulted in very strong share price performance over the last 2 years. And as a result of that, we've significantly reduced our holding in the company through market sales, and the realized portion of our holding in SEC has realized almost 3 times our original cost and an IRR of about 33% since September 2020. So a good case study of a company performing really well and actually being re-rated positively by the stock market. And you know, that may be a bit rarer at the moment because the market's a challenge, but it is still happening when companies really sort of deliver what they say they're going to do or better. The second case study is Ricardo. This is an example of a company which faltered and where it went off thesis, but because of our strategic engagement with the board and the management team of the company, we've actually ended up recovering value here through a sale of the whole company. The business was performing quite strongly until the end of 2024 and then had a surprise profit warning in early 2025, which resulted in a big drawdown in the share price. And there was a number of things which emerged from that, which completely changed our view in terms of the risk profile of this investment going forward. So we engaged very strongly with the execs and the board to push for a recovery of value on a fairly short time frame. And the choice was really, do we back the current management team to execute a turnaround and cut costs and recover value that way? Is there an opportunity to break the business up because the sum of parts valuation of the company we felt was very, very significantly higher than the current market cap? Should they consider a sale of the whole company? Or lastly, there was an activist shareholder that took a position after the share price fall, and potentially was there an opportunity to support them to go in and be more aggressive in terms of the organic turnaround plan? All of that culminated in a recommended offer for the company from WSP, a big Canadian listed company, and that offer was at an almost 70% premium to the sort of rolling average price over the previous 3 months. We supported that deal, having been over the wall and engaging with the board and the advisors in that process. And because we had a big equity stake, we're the largest shareholder, we were effectively pivotal as to whether or not that deal was to happen. So our support was what really unlocked and enabled that deal, which recovered value for SEC shareholders. We're due to receive the cash from that exit in the relatively near future. And then the final case study I'll talk to is Brooks Macdonald. So this is a UK wealth manager and financial advisor. It's a business which we've known for a long time. It's a sector which we've been pretty active in over the years, and it's one where we feel that the market is currently the market value is currently completely disconnected from the fundamentals of the business. The wealth and advice sector in the UK has been a very active sector for consolidation. There's been lots of mergers and acquisitions in the space, particularly in private markets, with private equity being very, very active. And this is a situation where, because of the sort of the negative flows that we've seen in UK smaller companies and the market values of all listed small caps being pretty depressed, it's trading at a discount, a very material discount, but almost half, in fact, the value that's been typical for private equity sort of M&A transactions in this sector. The range of those transactions has been typically between 12 and 17 times enterprise value to EBITDA, and Brooks Macdonald currently trades on around 8. So almost half price versus private equity transactions. We think the management team, which has been refreshed over the last couple of years, is excellent. We think the strategy is very clear. We think the business is poised to return to growth. And we think that if it does that and consistently shows that to the market, it will be right for a re-rating. But if that doesn't happen, then it's pretty clear that the M&A market is an alternative route to value for that business. And we are sort of working closely with the management teams to ensure that this business can deliver value to shareholders over the next year or two. So those are a very quick canter through the examples of companies in the portfolio. And just very lastly, I will just sort of talk about the opportunity for SEC and the market more generally. The UK equity markets are trading at big discounts versus international equities, particularly the US. You can see on the left-hand side, still, despite a recent uptick, at pretty much 30-year lows. Small caps are trading at big discounts to larger companies within the UK, and that's the hunting ground that we're focusing on. So there are lots of opportunities because of the valuation discounts. There's lots of takeover activity, and this slide just gives you a sense of the activity that we've been beneficiaries of over the last 5 years since I took over managing the trust. Almost a quarter of the holdings that we've owned in the trust over that last 5-year period have ended up being taken over, and that's a big proportion. The average multiple that those takeovers have happened at, enterprise value to EBITDA of 13.3 times, that compares to the 9 times the current portfolio trades at. So we think there's a big margin of safety on valuation, and then we think that takeover environment, which does mean we lose companies from the portfolio from time to time. We're not too concerned about that because the valuations of other companies which we have in the pipeline, or some of the smaller positions we have within SEC, mean we've got a pretty compelling opportunity to reinvest those proceeds when we do have takeovers into other compelling opportunities. So this kind of environment, whilst there's a lot of uncertainty out there at the moment, this is the perfect environment for the SEC strategy, because we feel we can deliver value through our proactive engagement, even if the market is not doing that in a more general way. And I will pause there and let James sort of take some of the questions from the floor.
Brilliant. Thank you very much. If you've got a question, please do put it into the YouTube chat box. We've got some already. So obviously, this is probably sort of perfect time for us to step back and think about SEC and how it's been and where it's going. Is there any merit in expanding the remit beyond the UK?
It's a very good question. Look, I think in the long term, that may well be an interesting thing to try and explore. However, this is a highly concentrated portfolio, so 18 companies currently. Most of the value is coming from 10. There are a large number, despite the recent sort of couple of years of takeovers and the numbers of listed companies falling somewhat. There's still a large number of companies in the UK small cap universe. In our view, there's lots of good quality companies, and at the moment there are loads of companies trading at big discounts in terms of their valuation. So we see plenty of opportunity in our core area of UK small cap, without having to sort of look too far afield and look overseas. And if that changes in the future, then we could potentially consider sort of expanding the remit. But at the moment, we think we are highly confident we can deliver really attractive returns from the universe that we're focusing on at the moment.
And your numbers actually been quite good within the sector recently. I mean, and the sector's been suffering because of the sort of UK small cap being out of favour. Can you see anything that might turn that? One of the questions here is really about the government and its actions. Is there anything that you think it's done that's been unhelpful, or things that it ought to be doing that would change things?
Yeah, so I think there's definitely a sort of pervasive negative narrative around is the UK open for business, the sort of government and tax regime, etc., which people are concerned about. And I think it's legitimate to be somewhat worried, especially given the UK's fiscal situation, and think it's pretty difficult line the government have to tread to kind of get us out of that. However, so and also given the last budget last October, with particularly increased payroll taxes being a sort of direct tax on business, which is clearly not gone down particularly well with the business community. So all that's the case. My view is that whilst there has been adverse changes which have happened last year and sentiment is poor, there is also a lot of good stuff happening, and there is the whole kind of government narrative around growth. Whilst people are sceptical about it, I do think there's a genuine willingness to listen to the business community. I was at the Houses of Parliament earlier on this week, on a consultation about the AIM market. There's a genuine willingness to reach out and listen. Whether it ends up with positive policies, obviously, I can't say for sure. But we see on the ground the companies. We talk to management teams, and obviously management teams are not unaffected by the wider sentiment. But the majority of the management teams we back and we talk to, they're getting on with it. They are trying to drive forward with their businesses, and they hope there's going to be a tailwind rather than a headwind. But there's still businesses that can drive and create value regardless of that. And you've seen that in the UK equity market. There's definitely a sort of sense of optimism despite the narrative. There's companies raising money, and whilst the IPO market's been really depressed, there are companies looking at whether or not to come to the market over the next few months, and way more than we've seen for the last couple of years. So there's a few early signs, green shoots of activity, and so the government may or may not be being favourable, but I think that the entrepreneurial spirit and the company management teams wanting to kind of take their businesses forward, we see that on the ground, and it feels a little bit better.
And actually, you've kind of alluded to some of these things already, but one of the questions is, are you worried about the shrinkage of the UK market through a lot of M&A that's been going on? I mean, are you seeing lots of opportunities for new investments?
So yes, I mean that's the sort of the irony of that kind of this whole narrative about de-equitization of the market. It's certainly true. The last 3 years, there's been more takeovers than there have been IPOs. The IPO market's been depressed, and the takeover market has been elevated. But that largely, from my point of view, is down to the market cycle, and it's down to valuations, the relative valuation between public and private markets, or between the UK and international markets. In 2021, which is not that long ago, it's only 4 years ago, it was the opposite way around, and private equity and venture capital firms were selling their companies to the stock market at high prices, and people were sort of lapping that up, and lots of IPOs of interesting growthy businesses, but maybe at too high a price in hindsight. But that's reversed. But the reason there's takeovers at the moment is because the valuation gap is so big compared to private markets that it's really compelling for a private equity firm or a corporate buyer to pick up some attractive businesses at low prices. And so, but that's precisely the opportunity we're playing into here. So we think, from our strategy's point of view, this is a great time to be investing because valuations are low. They're still good companies. And if the market doesn't recognize them, then the alternative route to value is through the M&A market. And that would be a problem if there were no other opportunities to reinvest into. But that's not the case, because there's lots of good companies, more good companies now at attractive valuations than they were in 2021.
Yeah, brilliant. Thank you. And there's a question here about what gives your team an edge, but I suppose maybe you could talk a bit about the depth of the team and the research you've got, and how you do that, how you apply that to making new investments.
Sure. So there are 5 of us in our direct public equity investment team that are all involved with SEC and our open-ended public funds. But then we've got 29 people in Gresham House that are involved in investing in private companies or sitting on the boards of private companies. And we sit right next to them. They're investing in the same sectors. And whilst there's obviously different nuances to the strategies in terms of the funds, what isn't different is that there is value in trying to build insight and knowledge about particular sectors or subsectors, and by having that wider platform and be able to cross-refer both insight and network between the two, we think we can drive a real edge, because we can get some really granular insight into what's happening on the ground in particular sectors, and we know a lot of people, and those people, if we know a healthcare services expert that's been a chair or an entrepreneur in that space, they don't typically think of themselves as a private equity person or a public equity person. They just think of themselves as a healthcare services person. So if we've got healthcare business that we're looking at in public, and we can tap into that expertise, and likewise in the private markets, and that's really valuable. And that's the thing which we think is our long-term competitive advantage. We're building that up over the last 15 plus years. It's built on goodwill and reciprocation. It's not, we're paying people to help us, and that is really difficult to replicate. And so I think if there's one thing you take away about our capability, which is different to the rest, is that network is a really sort of core part of how we find opportunities, evaluate them, and then manage them after we've invested. And in many cases, we can introduce either firms or high quality individuals to those companies to help them, and sometimes in non-executive board capacity, other times in as consultants to help them, or M&A advisors to help them to either sell their business if that's the right thing to do, to buy other businesses if that is, or to defend themselves from being bought at the wrong price, which is quite topical at the moment.
Brilliant, thank you. Now, obviously, with a very concentrated portfolio, and given the strategy you've got, your performance is quite lumpy, and it definitely doesn't track an index. So when people are looking at the trust, what's the sort of time horizon that they should be applying when they're looking at, are you doing well, are you doing badly? Yeah.
So we are typically thinking about a 3 to 5 year holding period when we make an investment. It's a typical sort of medium-term private equity type time horizon. Because we're investing in public companies, we do have extra flexibility in that we can gradually build a position, whereas typically a private equity firm would make one big investment, and we can also, there is some flexibility towards exiting as well. We don't have to wait for the whole company to be sold. We can sell incrementally in the market as well. So we have that flexibility. But typically, the portfolio turnover we would expect to be sort of in the low 20%, sort of consistent with a 4 or 5 year average holding period. So that's the sort of time period we would expect to be judged for our performance. And in terms of the individual companies, sometimes we own them for a relatively short period. Unfortunately, sometimes we invest and then they kind of taken from us earlier than we would have liked. And in other cases, we can own them longer. It really depends on the specific company opportunity and what we think the catalysts are and how we're going to realise the value.
Can you talk a bit about the dividend on the trust? So is there any attempt to try to target a dividend or pay a progressive dividend? Or
no, I mean, this is a capital growth focused strategy. The dividend policy is to pay out the income that's received from the underlying companies, and we are not specifically targeting dividend paying companies, although some of the companies do have dividends which are attractive. So XPS Pensions that I mentioned in a brief case study earlier on, that has an attractive dividend yield. It's very cash generative business which can afford to pay a decent dividend whilst also reinvesting to grow the company at the same time. And because it's a capital light business model, because it doesn't have any debt, it can pay returns to shareholders whilst sort of continue to do what it's trying to do. So those kind of investments will result in some income which comes back to shareholders of SEC, but it's relatively modest. So it's sort of typically it's been between 1% and 2% dividend yield on the trust. But as I said, we're not targeting a specific dividend, and so that will be lumpy.
Yeah, that will make sense. Thank you. Just thinking as a sort of macro picture a minute. So inflation's a bit sort of stickier than people would like. That probably means interest rates aren't coming down as fast as people would like. And we've got the sort of uncertainty about the budget being late. What's your kind of view of the UK generally?
Look, I think it's sort of, it's fashionable to be negative about the UK economy more generally, and frankly, I'm a bit more of a sort of glass half full than perhaps certainly the kind of pervasive narrative I hear from the city and from company management teams. So the UK is not firing all cylinders. We're not like the growth is not powering through, but it's not horrendous. And the average GDP growth since coming out of COVID is 1.8%. So it's lower than it was pre-COVID, but it's not zero. Which I think if you just took the sentiment, people would probably say we're not growing, but we are. Consumer balance sheets are pretty sort of strong. They're relatively so. They've rebuilt because people are saving more since COVID. So that's a decent backdrop. And like you say, inflation is a bit sticky, and interest rates are coming down more slowly, and so it's not all good. But then look at other places. I think if you talk to US global equity fund managers or investors in the Middle East, or people who are looking where to put their money from a global perspective, you've been through a period, the last 10, 15 years where it's been US only gaming town, but you're in a position now where the US is at peak valuations, peak concentration within global equity portfolios, peak concentration within the US market with certain sort of large tech companies. That's quite risky. If you try and think about the prospect for future returns from that sort of starting point, it's a bit more challenging. And you also had significant dollar weakness. If you were a sterling-based investor and you were looking at your portfolios this year to date, the FTSE 100 has performed way better in sterling terms than the S&P. In fact, this fund has outperformed the S&P over the last 5 years in sterling terms. So it's it's not all about the US, and actually the external view of the UK, I think, is a lot more favourable than we have domestically, and we're quite good at being self-deprecating. And actually, although there's lots of question marks politically in the UK, look at France or look at Germany. There's a lot more kind of polarization and kind of instability in the political system there, and then you can form your own judgment on the US as well. But there's been a lot of US equity money, global equity money, that has come into the UK this year. I think it's around $20 billion. So, and that's significantly more than has gone into other European markets. So I think the US probably sees this as a bit of a better opportunity than the UK. The FTSE 100 started to do well, and history tells you that UK small caps require the large caps to do well first before they start to recover. And usually, certainly over the last 40 odd years, when we've had drawdowns in public markets in the UK, the small caps underperform the way down. They lag on the recovery, but when they do recover, they recover much faster and to a greater degree than large caps do. So you get your outperformance over the cycle from that period, and I think we're closer to that than we have been for quite a while. Obviously, difficult to predict the precise timing, but you need large caps to start doing well before that happens, and that is starting to happen now.
Great, thank you very much, Ken. I mean, it all sounds relatively, looking further out, optimistic, I think. I mean, and probably that means now's not a good time to be cashing in. But I think that's for individuals to make their own choice. But you'd say if you just look out 4 or 5 years, then there's upside.
Yeah, and I am a personal shareholder in SEC, and Gresham House as a company is also an investor in SEC, and neither me personally or Gresham House corporately is intending to cash out at this point. And obviously we are somewhat biased, but nevertheless we see a great opportunity here for this trust. And I think what I was saying about the market recovery in small cap, we're not reliant on that. If that happens, it's going to be a great tailwind, and it will improve our ability to deliver good returns. But we think this strategy works effectively in this kind of difficult sentiment-driven market, because we're being very specifically targeted on individual companies where we can see reasons to believe and reasons that we can support as a big shareholder to drive value, even if the stock market isn't sort of cooperating on an aggregate basis.
Yeah, exactly. You kind of make your own luck, just about something else. So yeah, brilliant. Thank you very much indeed for today, and we'll follow with progress what happens. Sorry.
Thank you. Thanks for having me on.
We'll be back next week talking to the manager of Octopus Renewables, David Bird. So thank you for your time today. Please do vote in the awards if you hadn't already. I know one of Ken's colleagues is up for an award there, the Rockwell Strategic. So It'd be interesting to see what happens with that one. But thank you very much for your time today, and have a good weekend.